You begin trading with a spark of ambition, imagining the charts as treasure maps leading directly to your first million. In your mind, success is just a few clicks away, a string of perfect entries and exits that deliver instant wealth. The problem is that it's an illusion. Trading rarely, if ever, works like a video game where each level guarantees rewards. Instead, it's a grind, an unglamorous stretch of repeated decisions, tiny gains, and occasional setbacks that test your patience more than your skill. Most beginners underestimate this from the start. They see social media posts, flashy lifestyles, and screenshots of account balances growing seemingly overnight, and they think, if they can do it, so can I. The human brain loves stories like that. It wants cause and effect to be immediate, linear, and satisfying. Trading refuses to conform. This mismatch between expectation and reality creates the first, almost invisible trap: impatience. You make your first trades with excitement and optimism, but the market is indifferent. Your stop loss is triggered, your first sure thing evaporates, and the thrill of trading suddenly turns into irritation. Without a buffer of emotional preparedness, that irritation grows into frustration. And because the internet has trained you to crave instant gratification, you assume the market must be broken, or worse, that you are hurt. But what's broken is the expectation that a complex, probabilistic system will reward you on your timetable. The illusion of quick wins also fuels overconfidence. After a small profit, you might convince yourself you've cracked the code. That feeling is seductive. It whispers that your strategy is perfect, your timing impeccable. You double your size or chase trades without the discipline you initially promised yourself. The crash is more brutal when the inevitable loss comes because your initial illusion inflated the stakes. In this way, the first weeks or months of trading become an emotional roller coaster. Tiny highs that build false confidence, followed by sharp lows that shake it. This emotional volatility is exactly what encourages the majority of traders to quit before they've even scratched the surface of sustainable growth. Early losses are not failures, lessons, but the illusion of speed keeps you from seeing them as such. Every missed opportunity or losing trade is interpreted as a personal shortcoming, rather than an expected trading feature. The truth is, the market doesn't care about your dreams, plans, or excitement level. It's a mirror of probabilities, not ambition. Accepting this is critical because it shifts your perspective. You stop seeking instant validation and begin evaluating your decisions in a calm, measured way. Another subtle trap is the comparison effect. You watch peers' wins on forums or social media and feel behind, even if your progress is steady but invisible. That comparison drives riskier choices. Bigger positions, faster entries, more impulsive decisions. The illusion of quick wins doesn't just mislead. It actively encourages behaviors that accelerate failure. Trading mastery is a long-term accumulation of edge, discipline, and emotional resilience. By the time you realize it, many have already quit, believing the dream was a lie, when in truth, they underestimated the time, patience, and consistent effort required. The lesson of this first section is simple. The market doesn't reward impatience. Early quitting isn't caused by lack of intelligence or skill. It's caused by falling for the illusion that trading is quick, glamorous, and straightforward. To survive, you must recalibrate your expectations. Success isn't an immediate payoff. It's a gradual, almost imperceptible learning, adapting, and growing process. Every day you stick with your plan, every disciplined entry and exit, and every loss is accepted as a lesson rather than a judgment, builds resilience that compounds far more reliably than any quick win. This understanding, though initially boring and uncomfortable, is the foundation for everything you will encounter in trading. Fear is a constant companion in trading, and it wears many faces. At first, it shows up as hesitation. You see a trade forming exactly as your strategy dictates, yet you delay entry, convincing yourself the market might turn against you at the last second. Then it mutates into panic, whispering that every red candle is a personal indictment, every stop loss a failure of judgment. This fear is natural, but becomes a trap when it dictates your actions more than your plan. You enter trades timidly, exit prematurely, or abandon setups entirely, and over time, these tiny deviations compound into missed opportunities and mounting frustration. Most traders quit not because they lack strategy, but because fear slowly erodes their confidence and willingness to follow through. The stop-loss paradox is central to this struggle. You place a stop-loss to protect yourself, yet the very existence of that protective barrier can amplify fear. You obsess over it, staring at the screen, calculating the pain of a potential loss instead of focusing on the trade setup and probabilities. Every tick toward your stop feels like a personal failure, even though the stop loss is designed to prevent catastrophic loss. You begin to question every move. Was I wrong to enter? Should I have waited? What if the market keeps going against me? Your rational plan is drowned in emotional noise. This is why many traders abandon their strategies. They react to fear rather than follow rules. Fear is especially potent because trading is public only to the market and private to your conscience. No one else knows your position size, reasons for entry, or the stress building in your mind. You wrestle with fear alone, often magnifying it internally until it feels unbearable. Beginners frequently mistake this intensity for market insight, thinking their anxiety signals that something important is happening. In reality, it signals emotional dominance over rational process. Every moment spent fearing a loss is a moment of discipline lost. Over time, these moments accumulate, and the initial thrill of trading becomes a source of dread. One of the most insidious effects of fear is indecision. You might have an edge, a straightforward trade setup that meets your criteria perfectly, but fear forces you to second-guess yourself. You hesitate, partially enter, or reduce position size below your system's dictates. Even if the trade moves in your favor, your hesitation limits your profits and reinforces doubt. If I had only trusted myself fully. This cycle repeats, embedding fear so profoundly that the strategy becomes secondary. Traders eventually quit, not because they cannot trade, but because fear has made trading emotionally exhausting. To counteract this, resilience must start with detachment. Your focus should be on execution, not outcome. Losses are not verdicts. They are expected events that confirm your risk management is functioning. When fear dictates action, you stray from the systems designed to protect you. The best traders learn to recognize fear as a signal to adhere strictly to their plan, not as a reason to exit or alter it. Over time, this practice builds confidence that is independent of market movements. You stop reacting to the immediate noise and start responding with calm, structured discipline. Understanding and accepting fear is not a one-time lesson, but an ongoing process. The market will always present uncertainty, and fear will test your resolve. The difference between those who quit and those who persist lies in the relationship with fear, whether you allow it to control your decisions or use it to reinforce your discipline. Every trade that challenges you, every tick against your position, is a chance to practice emotional mastery. Without confronting this paradox of fear and protection, most traders quit before they even reach the point where their strategies can compound into meaningful growth. Overtrading is a subtle, creeping danger, and it begins innocuously. You make one or two trades, perhaps driven by a small win or a lingering sense of, I need more. And suddenly, your day becomes a series of impulsive entries. Each trade feels justified in isolation. You see a setup, it meets some criteria, and you act. But when compounded, these small, rationalized decisions create mental fatigue, quietly undermining your judgment. Overtrading is not just about losing money. It's about eroding the clarity of thought and emotional stability necessary for consistent execution. The more trades you take, the less energy you have for disciplined observation, and the more likely you are to deviate from your plan. Mental exhaustion doesn't always announce itself dramatically. It creeps in as micro-errors, slightly mistimed entries, exits made a few ticks too early, or hesitation where decisiveness is required. The brain can only sustain high-level decision-making for so long, and each additional trade chips away at that capacity. Beginners often misattribute these mistakes to bad luck or market unpredictability, never realizing the true culprit is fatigue from excessive activity. Ironically, the more you chase the market, the less able you become to read it accurately. Overtrading creates a cycle of diminishing returns where effort multiplies but results decline, leaving frustration to mount. Another consequence is emotional depletion. Every trade, even when successful, carries a small emotional toll. Wins generate excitement, losses trigger disappointment, and the combination wears on the psyche. When you take trades too frequently, your emotional reserves are drained faster than they can replenish. You start to react, not think. Your decisions are colored by impatience, hope, or fear rather than logic and strategy. In this state, a single unexpected move can feel catastrophic, causing abrupt shifts in position size or complete abandonment of your plan. The brain, overwhelmed by repeated highs and lows, begins to associate trading with stress rather than opportunity, nudging you ever closer to quitting. The underlying driver of overtrading is often a misalignment between desire and process. You want to make money fast, and the market offers endless stimuli: charts, news, indicators, and price movements. Your mind interprets activity as productivity, equating constant engagement with progress. Yet, real progress comes from selective, disciplined action, not constant motion. The key is recognizing that each additional trade is a choice that consumes both mental and emotional capital. Whenever you trade without necessity, you trade away focus, resilience, and the capacity for rational decision-making. Structure and boundaries are essential to breaking free from overtrading. Limit the number of trades per session, define precise entry and exit rules, and enforce mandatory breaks. Discipline in action prevents exhaustion and preserves cognitive clarity, allowing you to respond to opportunities rather than react to impulses. Many traders who quit prematurely never implement these boundaries, mistaking raw activity for mastery. By contrast, persistent traders understand that patience and selective engagement compound better than any string of frequent trades. Overtrading also reinforces a subtle psychological trap: the illusion of control. You feel as if constant activity influences outcomes, when in reality, the market operates independently of your desire or attention. Learning to step back, observe, and act selectively cultivates calm and perspective. The ability to resist unnecessary trades, allow setups to accumulate, and let the market reveal itself on its own terms separates those who burn out quickly from those who endure long enough to experience consistent growth. Mastering this balance is not glamorous, but it is the quiet, invisible work that builds longevity and ultimately defines success. The quest for perfect timing is one of the most seductive illusions in trading. You watch the charts, scanning every candlestick, every moving average, every tiny oscillation, hoping to pinpoint the exact moment to enter or exit. A part of you believes that if you could find that perfect moment, profits would be effortless, losses non-existent. But the truth is harsh: ideal timing doesn't exist. The market is a probabilistic system, a dance of countless participants and variables, many of which you cannot observe or predict. The obsession with precision becomes a trap, a self-imposed barrier that prevents consistent execution. This fixation creates paralysis. You see setups forming, but you wait, convinced a better price is just a tick away. That tick never arrives in the way you expect, and opportunities pass unnoticed. The more you chase the ideal entry, the more trades you miss, and the frustration grows. Over time, you associate your patience with failure because profits seem elusive. Yet, the market rewards disciplined engagement, not perfect timing. The irony is that waiting for perfection often ensures suboptimal outcomes, while simple, consistent execution compounds far more reliably. Another consequence of timing obsession is overcomplication. Traders layer indicators, oscillators, news feeds, and chart patterns on top of one another, hoping to eliminate uncertainty. The resulting analysis paralysis makes any decision feel monumental. Every trade feels like a test of skill, an ultimate judgment on your intelligence. The market, indifferent as ever, continues to move, indifferent to your elaborate plans. When the inevitable loss occurs, personal failure intensifies, reinforcing the belief that the market is punishing you for not timing it perfectly. It's a cruel cycle. Striving for precision leads to missed opportunities, emotional strain, and self-doubt. This obsession with timing also amplifies emotional reactivity. Traders who wait for the perfect setup are hyper-aware of every market twitch, treating each fluctuation as a signal or a threat. Anxiety skyrockets, and decisions are influenced more by fear or hope than by systematic reasoning. Even after a successful trade, the memory of hesitation lingers, creating a subtle, nagging doubt. The mind begins associating every trade with stress and anticipation rather than structured process and probability. Over time, this emotional burden can become unbearable, prompting many to quit rather than endure the relentless tension. Consistent traders, by contrast, accept that timing is probabilistic. They define entry zones, set risk parameters, and adhere to their plans regardless of the perfect tick. They focus on processes they can control: position size, risk management, and adherence to rules, rather than outcomes they cannot dictate. This shift from chasing perfection to mastering execution separates long-term survivors from those who burn out. It's not glamorous and rarely appears in social media traders' screenshots, but it is the backbone of sustainable growth. The lesson here is simple but counterintuitive. Chasing perfect timing is a path to frustration, while disciplined process leads to consistent results. The market will always move in ways you cannot predict. The goal is not to outguess it, but to respond effectively within a framework that protects capital and maximizes opportunities. Those who learn this lesson endure. Those who do not often quit. Understanding the futility of perfect timing frees you from the stress of chasing it, allowing focus, patience, and execution to compound quietly but powerfully over time. Resilience is the invisible force that determines whether a trader endures or quits. By the time you've navigated impatience, fear, overtrading, and the illusion of perfect timing, your mindset has been tested repeatedly. Most traders fail not because they lack knowledge or skill, but because they reach a point where the cumulative pressure of these challenges becomes intolerable. Resilience allows you to continue when the market refuses to cooperate, when losses mount, and when the allure of giving up becomes almost seductive. It is less about enduring single events and more about sustaining effort and discipline over weeks, months, and years. Every successful trader has a story of quiet persistence. They experience losing streaks, unexpected reversals, and setups that fail despite perfect conditions. Yet they remain engaged. They do not take losses personally. They see them as feedback, not judgment. This detachment from ego is essential. The moment you attach identity to results, every minor setback feels catastrophic. The resilient trader separates self-worth from market outcomes. They do not quit because they can't tolerate failure. They adapt, learn, and apply corrections without panic or self-recrimination. The quit point often arrives subtly. It's not a dramatic moment of decision, but a slow accumulation of doubt, fatigue, and frustration. You start questioning your abilities, plan, and reasons for trading. You may rationalize giving up with external explanations. The market is too hard, or I don't have enough capital. But beneath these justifications lies emotional exhaustion. Every trader encounters this moment. Those who succeed recognize it as a signal to reaffirm commitment to their process, not as a verdict on their potential. Those who quit interpret it as proof that trading is beyond them. The difference is entirely in perspective and mindset. Developing resilience requires deliberate practice. It starts with small, consistent habits. Following your plan regardless of outcome, journaling trades objectively, and reviewing mistakes without judgment. Each step reinforces confidence in your process and reduces emotional reactivity. Resilience also involves realistic expectations. Acknowledging that trading is probabilistic, that losses are inevitable, and that mastery is a long-term pursuit. By internalizing these truths, you create a buffer against despair, making it possible to continue through the grind when others abandon their efforts. Perhaps most importantly, resilience is reinforced by patience. Traders often underestimate how long it takes to see consistent results. The market rewards persistence more reliably than intuition or timing. Every disciplined decision and every trade executed according to plan compounds quietly, building skills, understanding, and equity over time. Those who quit too early deprive themselves of this compounding effect. By contrast, traders who endure and survive the grind find that what once seemed impossible, steady gains, mastery over emotion, and sustainable strategy, becomes reality. In the end, resilience is the threshold between quitting and succeeding. The skill allows you to navigate fear, impatience, and frustration without losing your edge. It is not innate but cultivated through consistent practice, reflection, and a commitment to process over outcome. The traders who succeed are not always the smartest or the most talented. They are the ones who refuse to let the inevitable challenges of trading break their discipline. And it is in this quiet, persistent refusal to quit that long-term success is born. Now that you've journeyed through the illusions, fears, and pitfalls that claim so many traders before they succeed, the path forward is more straightforward. Trading is not a sprint, but a marathon of patience, discipline, and emotional endurance. Each misstep, each moment of hesitation, each loss endured is not a failure but a lesson, a building block in the foundation of a sustainable trading career. The quiet, invisible work of following your plan, managing risk, and mastering your mind compounds far more reliably than chasing instant profits or perfect setups. Imagine trading as tending a garden. You carefully plant seeds, water them consistently, and remove the weeds that threaten growth. You cannot force them to grow faster by staring at or moving them around. Growth requires time, persistence, and the humility to accept natural cycles. The same principle applies to trading. Discipline, reflection, and patience are the nutrients that allow skill and understanding to flourish. The traders who quit early are like those who uproot seedlings at the first sign of slow growth. They never see the fruits of their efforts. Those who endure reap a harvest that the impatient cannot imagine. This perspective changes your relationship with trading. No longer is it a game of chasing wins or avoiding losses. It becomes a structured practice, a daily commitment to improvement, resilience, and process. The market is indifferent to your desires, but rewards those who consistently act with clarity, patience, and control. By shifting focus from outcome to execution, you reduce fear, limit overtrading, and escape the trap of chasing perfect timing. You begin to trade not because of excitement or ego, but because of deliberate choice, guided by strategy and self-awareness. Above all, remember that quitting is easy, but enduring is transformative. The psychological battles, the impatience, the fear, the overtrading, the obsession with perfection, are universal. Every trader confronts them. The difference lies in how you respond. Persistence does not guarantee instant success, but it guarantees experience, knowledge, and the compounding of skill and confidence over time. Success in trading is rarely dramatic. It is often invisible until undeniable. So, as you step forward, internalize this truth. Mastery is built in the quiet moments of discipline, reflection, and resilience. Each day you commit to your plan, each trade you execute with patience and control, you edge closer to that level of consistency others only dream about. Trading is not about quick wins, but about enduring the grind, learning from every setback, and refusing to quit before the rewards naturally follow. In the end, those who succeed are not the luckiest, the fastest, or the smartest. They are the ones who persist long enough to see the invisible work pay off in a visible, lasting way. If you found this insight valuable, don't let it end here. Subscribe to the channel to continue sharpening your trading mindset and uncover strategies most traders never see. Hit the notification bell so you never miss a lesson that could change the trajectory of your trading journey. Share this video with other traders who need a reminder that persistence, discipline, and resilience are the keys to success. Together, we build a community of informed, patient, and unstoppable traders, one decision at a time.